Hello, everyone. Good evening, and welcome to the third episode of Cryptocurrency: A Brave New Wealth. I'm your host, Lai Yuen. I'm a year 4 student studying at NUS Business School, and I'm also a crypto investment analyst at a fund. Right, and joining us today is Prof. Lee, and Prof. Lee is also a financial professor in NUS, and he teaches the fintech and financial analytics classes. I used to be a student in one of his classes. And today we'll be talking about how we can go about investing in cryptocurrencies and talk about their risk and rewards. So, Prof. Lee, please.
Good evening. How are you doing? So, how many of you have invested in cryptos before? I can't see your hand, but I know some of you have made a lot of money, some of you got burned, and some of you have given up. Today we are going to talk about investing in cryptocurrencies, what are the risks and rewards, and this is a roadmap. So, we will first look at the different perspective of different stakeholders with regard to whether cryptos are the right investment vehicles, from the Nobel laureates to the practitioners to the central bankers. And then we will move on to talk about investing in cryptos, specifically how you should invest if you choose to invest, if you can afford to lose. And we are going to talk about three risk management tools: diversification, optionality, and insurance. And finally, we are going to talk about some near-term risks. And some of these risks are systemic. For example, the recent regulatory crackdown, as well as some application-specific risks. So let's start. Let's talk about the different perspectives on crypto. So let's ask the Nobel laureates, what are their views on cryptos? They are skeptical in general. So if you look at what Robert Shiller said, he thinks that Bitcoin is a remarkable social phenomenon, but it is a speculative bubble, specifically an epidemic of enthusiasm. And you know, when he said that, Bitcoin was around 6,182. That was in 2018. Now let's ask Joseph. Bitcoin is successful only because its potential for circumvention, lack of oversight. So it seems to me it ought to be outlawed. That's a strong statement. It doesn't serve any socially useful function. So very critical. Let's move on to ask what Paul think about Bitcoin. Bitcoin is evil. Again, very strong statement. I'm still deeply unconvinced. So let's ask the practitioners, what do they think? The practitioners are divided. And if you were to look at the three people here, Peter and Jamie Dimon, both of them have changed their view over time. Let's begin with Warren Buffett. So you can't value Bitcoin because it is not a value-producing asset. We know where it comes from. It's a value method, so that makes sense. It's a real bubble. How about Peter? Bitcoin critics are underestimating it. It's like a reserve form of money. It is like gold, and it is just a store of value. However, Peter sort of changed his perspective on this in the recent few months. If you're interested, you can find out what he said. And then Jamie Dimon. I regret making comments saying Bitcoin is a fraud. Blockchain is real. You can have crypto, yen, dollars, and stuff like that. So practitioners, at best, they are divided. Let's ask the central bankers. What do they think? The central bankers are concerned. Back in Singapore, Taman said that cryptocurrencies are highly volatile. Indeed, if you talk about Bitcoin, the maximum drawdown is 40% in a day, as their value is typically not related to any economic fundamentals. So this has the same sentiment as what Warren Buffett has said. So it's not suitable for retail investors because they are just too risky. Now let's ask Jay Clayton from US SEC. We have seen historical instances where certain investments, innovations, benefited our economy and those investors who back the right ventures. But when our law are not followed, the risks to all investors are high and numerous. And in a sense, this is what we are observing right now. For example, in the DeFi space, you see a lot of innovations. Innovations that would not be possible without cryptos. That would not be possible with centralized finance. And in a sense, there are certain parts of cryptos that are wild west. For example, the ICO space in the past, and right now the IDO space. You have non-existent disclosure, it's subject to manipulation, and then occasionally you will hear certain things happening, like theft, something being hacked, just like Polygon networks a couple of weeks ago. So this is the sentiment. Now let's look at the last person on the list. So here, this is what has said. He said that regulators in some jurisdiction, and we do see some of certain jurisdiction, they are trying to curtail activity in this space. For example, China banned the space, ICO to be specific, and crackdown on mining activity. And you see that in other countries as well. But allowing crypto to interact with our traditional legacy financial system, and this is really our centralized finance, that is a much better way for regulators than to get to know the technology and get to know this asset class. So this is basically my view of how crypto is going to evolve. Right now, it's pretty much still a wild west, looking for a reason to exist. However, the potential is high. The potential for new innovation is high. The question is, how do you deal with that? Do you kill it, or do you allow it to flourish, but under close supervision? Now, let's ask the question. Let's say you are fine with all those concerns, all those negative points on crypto investing. What else do you need to invest in the crypto space? You have to ask two questions here. Can you afford to lose what you invest in cryptos? And I mean losing every dime. And the second question would be, can you live with an average of 5% daily price swing or a one-day drawdown of 40%? Can you start on that? If your answer is yes, then you should continue, stay with me, and listen to what I have to say. If your answer is no, I would say do not touch this asset class. All right. Now, let's talk about investing in crypto. Again, I'm assuming that you are fine losing everything, and you are fine with 4-5% swing every day, as well as a possibility of 40% drawdown in a single day. All right. Now, so if you insist, if you still want to invest in crypto because of the bright future, let me show you how Bitcoin, for example, is placed in this X and Y. So the Y here is basically the average annual return. The X here is basically the annual standard deviation of return. You have your bonds, currencies, dollar to be specific, gold, S&P 500 right here. All right. To some of you, this is not interesting. Okay. So some of you want exposure to idiosyncratic risk. They will give you idiosyncratic reward, and this will be the light of investing in individual names. Amazon, Netflix, Google, Facebook. You have more return, but you also suffer from bigger risks. And risk here is defined as volatility. Now, Bitcoin is entirely different. It's like out of the league. It's up here. So if you were to look at Bitcoin, the annual return is more than 100%, but the volatility is more than 70%. And the maximum drawdown is up to 40%. Daily swing can be 4-5%. All right. Now, So this is what you are looking at when you have exposure in Bitcoin. And of course, when you talk about crypto, Bitcoin is not the only thing. You have many others, and it's a very interesting space. And each of them would have different risk-return profile. So let's talk a bit about that. Let's say you still want to invest in crypto. It doesn't matter. The volatility you can stomach. Then how do you maneuver in this wild west? Risk management is crucial. And by risk management, I'm talking about three key components: diversification, optionality, and insurance. We will first talk about diversification. Now, first of all, crypto returns are asymmetric. What I mean is that you have a lot of skewness, negative skewness and positive skewness. So, for example, Bitcoin, Ethereum, they tend to be slightly negatively skewed. You have Ripples and a bunch of others, they tend to be positively skewed. Now, how do you make sense of this? When we talk about negative skewness, this would be the line of return where you make a beat every single day, but all those returns can be washed out with 1 day of down return. And on the other hand, when the returns are positively skewed, on average you lose a bit, but it will be more than offset by some really good days, right? So when we talk about skewness of different exposure, and by exposure here I'm talking about different cryptos in the form of different tokens, right? You want to engineer in such a way that the skewness is what you are comfortable with. Do you want to have no skewness, a little bit of positive skewness, or negative? And in doing so, it helps you to, at least engineer the kind of risk-reward profile that you want from the perspective of return skewness. All right. Now, what do you do next? One thing is that cryptos is really a very complicated world, and there are a few dimensions to look at it. And you want to diversify across all these different dimensions. First will be ecosystem. When you talk about ecosystem, you have various networks that you can invest in. Ethereum, Solana, all these are different ecosystems on which you can build applications on it. Okay, so you might want to spread your bet across different ecosystems. Really, you do not know which one is going to be the winner in the future. And when you talk about ecosystem, typically we are talking about ones in which you have smart contracts that allows you to build applications, cool applications that will potentially replace what centralized finance has been doing. DeFi, for example, is building on Ethereum. Okay. Now, use cases. So when you talk about ecosystem, the next question you want to ask will be, what are some of the use cases that can be built out of the ecosystem? Or what are some of the tokens that are independent from the different networks on their own? Why do they exist? What is the business model? What is the usage model? So you're gonna find out what is the different use cases. Why? Because whether you invest in this coin or that, it is a function of your point of view, say 5 years down the road. So you need to form a point of view, whether this use case is going to be successful, whether the business model makes sense, whether the technology is good, whether the team and the community have the necessary talent for the ecosystem or for the use case to be realized. All right, and you do not know which business model is going to survive in 5 years' time, and that's why you want to diversify, to spread your bet. Okay, so now let's move on to the third component. The third component will be applications. So here we're talking about various applications serving the same use case with different characteristics. And for example, if you want if you want to talk about, say, digital exchange that would replace the exchanges that we have right now, we have a bunch of options out there. We have, and each of these exchange allows you to trade derivatives and a host of creative instruments. So the question now will be back to the same question. Would the business model around all these applications survive the test of time? Now, methodology, here we are really talking about the technology behind the implementation. And even though they have the same problem to solve, but using different means, the different means may matter because some technology might be more advanced than the other. And sometimes you have to sacrifice certain things to achieve other things. For example, if we talk about payment, there are three options that you can that you look at, and of which you can choose only two, right? So when you design your blockchain, you can choose for scalability, security, and decentralization. If you talk about Bitcoin and Ethereum, they basically forgo scalability and go for decentralization and security. That's why they have scalability problem. And it's a design choice. However, if you talk about Ripple on the other hand, forgo decentralization, they go for scalability and security. That's why they have a very different use case, and they have a very different business model. For example, a lot of the cryptos are out there to kill the banks, or the money changer, but not for Ripple. Ripple wants to work with them, wants to work with the incumbent players to facilitate fast, cheap, and better Forex. All right? So technology matters. Now, finally, let's talk about the time dimension. So we have seen different use cases, different application, different ecosystem, and different technology. Do you need to have the same time investment horizon for each of them? No, it really depends on what you're investing in, the use case. For example, Lai Yuen, what are you into right now?
I'm currently looking into on-chain derivatives trading, which I think it's interesting in both the TradFi and DeFi space. So
Okay.
yeah, that actually diversifies across multiple dimensions, as you mentioned. Yeah.
Okay. And also you're playing around with the 8 thing, right? The game.
Oh yeah. So I'm playing around with Axie Infinity as well. So Axie Infinity, it's an application built on Ethereum that allows users to play a game that's quite similar to Pokemon, and users actually earn money playing this game. And
Okay.
it's seen quite a lot of traction in Philippines as well. So the amount of money that you earn from playing Axie Infinity is, for example, can exceed the average salary in certain parts of rural Philippines. So
All right.
that's also another interesting development that is currently in the crypto space right now that investors can invest in. Yeah.
So for the case of the egg, it's really the use case for non-fungible token or NFT. And what is cool about that is that you can represent or tokenize various kind of assets and digitize it within blockchain. And what Lai Yuen has been doing is to pick the right egg, and in hope that the egg will turn into something cool that can be sold for a high price. And this price can be turned into fiat. So if you talk about the investment horizon for egg picking, it's very different from buying into an ecosystem that would enable a bunch of other things. For example, Ethereum. So the time horizon matters, and it depends on the specific use case. Okay. Now let's move on to the next component. So what's the point of having crypto? And here, I'm not talking about having all your money in crypto. Although Lai Yuen, I think most of your wealth is tied to crypto, right? Anyway, so traditionally, most of us have a bunch of traditional, exposure, and by that I'm talking about real estate, cash, bond, equities, emerging market, and commodities. And with all those traditional assets, this is the best we can go, the efficient frontier over here, excluding cryptos. However, if you were to add cryptos, what will happen is that the efficient frontier will move up. This is good. Why? Because for the same level of risk, you are going to enjoy higher return. Or another perspective, for the same level of return, you are going to have lower risk. So it moves the efficient frontier. And what is the economic reason behind? The economic reason behind is that crypto, I'm not specifically talking about Bitcoin, but a host of all the different tokens that you have seen, from NFT to all the different applications, from A to Compound to, so all these different tokens are going to have return profile that is a little different, a little detached from how the traditional asset would move. Okay, so if you were to engineer it correct, then what will happen is that you are going to have the red line instead of the blue line. Okay, so that's what is cool about having crypto in your traditional portfolio. Of course, the next important question will be, how much should you put into your traditional portfolio? If you were to do a Google search, the number 5% often pop up. If you were to run through different surveys and different recommendations from experts, the allocation is generally between 0 to 10. Okay, with 5 being the most common. Now, let's move on to the next risk management strategy. So the first is diversification across different crypto features, and then you diversify by the different the return profile, specifically skewness, and with that, what do you have? You have a better efficient frontier. Okay, you get more return with the same risk, or with the same return but lower risk. Now, the next thing that you want to consider to risk manage is optionality. Here, we are talking about buying a token like Ethereum, Solana, and Polkadot. These are ecosystems. And what ecosystem does is that it gives you the smart contract to create things, to create applications. And the possibilities are limitless. So, if you were to put it in finance terms, it's the like of buying a real option on the future of the protocol or the ecosystem. In other words, what can, for example, Solana enable? Ethereum, for example, enables the development of decentralized finance. And we know that decentralized finance is so exciting. So there are so many use cases. All right. Whether it will survive, that's another question. But right now, we see a lot of very, very interesting, very innovative products coming out of from the DeFi world, and all of them built on Ethereum base layer, and through some implementation of the smart contract. So then you ask me, how is it different from, say, digital money in the past within the incumbent banks, for example? Now, one key difference between digital money with the bank versus digital money in the crypto space is that digital money means that it is programmable, right? But the problem is that when you have digital money with the bank, the ecosystem is closed. That means talented people like you can't contribute to the development of new innovative product. However, if you talk about crypto, it's open. As long as you know the rules of how to create a smart contract, you can get really creative as to what you can do. So the power of the collective is unleashed, and hence it is so exciting and so innovative. All right. Relatively speaking, cryptocurrencies, of which the use case is payment, is boring. Now, let's move on to the third risk management tool, insurance. Don't underestimate that. You do not know when bad things will happen. So buying insurance protect your, for example, crypto wallet for the extra peace of mind. And many things can go wrong. from cyber attack to brute force attack, Trojan hacking, insider attack. All this can be protected, and there are insurance out there that offer various kind of protections at a fee. All right, so buy some of this insurance for peace of mind, especially if you are going to have wallet of your own. If you put your money in ETF, that doesn't matter. Let them manage that. But if you are managing your own wallet, this is something that you might want to consider. Now, so this is basically a chart showing you how a bit of cryptos may spice up your traditional portfolio. If you were to look at this chart, if you invest in just S&P 500, it will be the gray line. Okay, so 100 here means the principal amount that you invest, and if you were to invest 5% crypto and you rebalance it quarterly, you are going to have the pink line. If you were to put 2% crypto and you buy and hold, you are going to have the red line. So we just 2 to 5% in this case, your portfolio looks very different from the case where you just hold the traditional asset, in this case S&P 500. All right, so cryptos play a role, but you have to have the heart to deal with the volatility. As I have said, the drawdown, the maximum drawdown can be 40% a day, and the daily swing can be 5%. And your money may disappear if you were to invest in the wrong token. All right. Now, let's look at the near-term risks. And by near-term, I'm talking about something that may happen, the next few weeks or the next few months. All right. Number one, it will be the regulatory crackdown. There's a rise in the potential regulatory crackdowns in the crypto space to protect investors. Remember, if you invest in crypto, you have no protection whatsoever. You are on your own. If you have your own wallet and you forget about your private key, sorry, that's it. There's no number to call. There's no technical support. Okay? So what do I have specifically in mind? Stricter audit of USDT reserve, and this is Tether. And Tether is basically a stable coin that promises one-to-one pegging between its token and US dollars. And what is the use case for USDT? If you have made a lot of money from Bitcoin, do you want to still hold your Bitcoin as Bitcoin? You probably don't. Why? Because if you want to lock down your profit, you want to either turn it into fiat or hold it into the light of a stable coin like Tether to basically lock in your gain. If you leave it as Bitcoin, it will just continue to fluctuate with that 5% daily swing. So now that's why USDT is a very popular stablecoin. And if I remember the number correctly, it's about 60-70%. Am I right, Lai Yuen?
Yeah, I think that number's quite accurate, but it's slowly declining right now. Yeah.
It's declining in part because of a competitor, USDC Circle,
Yeah.
right?
Correct.
Yeah. And one of the use case for USDC relative to Tether is that they subject themselves to serious audit. They open up their books, better disclosure. So that's the selling point. They are trying to fight against Tether. So they identify the pain point and trying to address that with the corresponding high quality disclosure. So there has been a rise in the concern around the world of the reserve status of USDT, which is the key part of the crypto economy, as I've said, 60-70%. And what happened is that the traders, they believe, the one-to-one peg is what is claimed. But if you were to ask the traders in the crypto space, for example, let me ask you, do you believe that the peg is one-to-one?
No, honestly, you're safer thinking that it's not one-to-one, and you're better off parking your assets in other stable coins. Yeah.
In fact, if you were to look at what they disclosed, it is not backed by one-to-one hardcore cash. I mean, specifically US dollars. They are in the form of commercial paper with credit risk. All right. So this is the concern. Let's move on to the next. Regulation of crypto assets under the SEC as securities. So under the Joe Biden's infrastructure bill, if you were to read that many pages of bill, there's one page that says, crypto should be treated as securities instead of commodities. And what is the implication here? The implication here is that cryptos needs to go through what the traditional finance would have to go through. For example, KYC. And if this, this paragraph is not removed, you're going to have an issue. DeFi is going to experience a potential meltdown. So the good thing is that it is still in discussion. They are aware of it. How this is going to pan out, nobody knows, but it is a risk. Now, let's move on to the third. Potential regulatory pressure from the launch of central bank digital currencies. This is a very hot topic right now. So the launch of CBDC may compete with private crypto assets. Now, then you ask, so why? If you ask me why cryptos exist, it's really, to many, it is a big shot against the existing financial system, against the establishment. Do you share the same sentiment, Lai Yuen?
Yeah. It's really a big shot against centralized designs based on the sentiment of various investors on Twitter, and even that you look at the origin of Bitcoin, it really grew from a distrust of centralized power. Yeah.
Mm-hmm. So if you were to look at how Bitcoin evolved over time, they tend to, Bitcoin and of course a bunch of other alternative coins, they thrive when you have the light of global financial crisis, when there's a loss of trust in the government. And if you were to look at where it would have the best use case, it is really with countries that have little trust in their government, where the economic system and the political system are sort of in a mess. So, so in that sense, it's a big shot against the institution or establishment. Now, if CBDC can repair or rather reinstate that trust, then the use case for cryptos in general is going to be much bigger. Is it going to be like that? I do not know, but we will see. It all depends on how the CBDC is being designed for a jurisdiction. Okay. Now let's look at application-specific risk. So we have spoken about some of the systemic risk. All right. Let's move on to talk about some of the idiosyncratic risks. So application-specific risk. Now, different crypto assets have different risks involved, and individual investors are responsible to conduct their own research. As you remember, Warren Buffett once said that risks shouldn't be defined as volatility. The finance professors are not quite right. It should be defined as wrongly judging the business. In other words, it's how much you understand of the business. Same thing here. When you talk about crypto, you really need to understand it, as if you are trying to understand the business, but it's a little more complicated. Why? As I've said, you need to understand the technology, the use case, the business model, the founding team, and the community surround the tokenomics. All right. So, or rather the token or the application. So you need to understand all this, because if not, then you're bound to accidentally step into one of those landmines. Now, let me talk about some of the application risks. Number one will be 51% on network that would break the consensus. Why? Because here you can lead to double spam, and the participant will lose faith. What do I mean by that? So if you talk about centralized finance, where does the trust come from? The trust comes from trusting an entity. For example, central bank. For example, your financial institutions that are regulated by the central bank, right? Now, if you talk about blockchain, the trust does not come from an entity, but it comes from the protocol. So what is the consensus mechanism among the players within the system in the form of proof of work or proof of stake and so on? Now, 51% attack, has it happened before? It has happened before. In fact, it is not uncommon, especially for the small cap coins, alternative coins. For the big cap coins, some of the hard forks experienced that before. And actually, if you were to think carefully about that, there is no incentive for anyone in the system to be seen as having 51% mining power. In fact, it has happened once, one of the hard fork of Bitcoin. What happened is that this mining pool, they exceeded the 51% threshold, and it caused a little bit of unhappiness in the system, and they know that. So what happened is that a few of the participants within the mining pool pull out. So they have no interest to breach the 51% threshold, because they will be shooting their own foot in doing so. Next will be hacking of protocols. Now here we're talking about smart contracts that are not very well written, or at least with vulnerability. And if you think about it, this is not uncommon. You've seen a lot of news flow on Microsoft having this day one exploit or vulnerability that need to be patched. It happens in the world of crypto as well. The problem here is that once a vulnerability has been found, it can be hacked. Just a few weeks ago, we have hacking of Polygon networks. Polygon networks is basically a bridge to different blockchain, and smart contracts has certain vulnerability that got exploited with millions of dollars being moved. There's an interesting story behind that. If you are interested, you can Google search. Last will be pump and dump schemes and information asymmetry. This is especially the case if you are investing in launchpads. What I mean by launchpads? Launchpads are basically the like of early stage, startup. Okay, and instead of raising capital the traditional means, they go through the crypto space. Now, here is the problem. They are bad players in that space. So my study, I look at ICO, but right now ICO is already, dead. So now you have IDO. And IDO, the D here is the digital exchange. And what is the problem with the like of launchpad startups looking for money through cryptos? The problem is that in the past, for ICO, what you need is just a piece of white paper. Send it out, let people read, and then let people decide whether to invest. And 70 to 80% of the time, you get nothing back. Why? Some of them failed. Why? Because the business model failed. And some of them are generally out there to basically, make something new to the world. However, they are a bunch of bad players that swindle your money. All right, that was ICO. Now, IDO, do they still exist? You bet. I guess, my guess is that you will still see that, especially if you are buying launchpads from the less established digital exchanges. So if you really want to go into that space, you really want to buy from reputable digital exchanges because they will do the screening for you. But even that doesn't guarantee that your investment is going to be safe. Why? Because we are talking about early stage ideas. So some of those business models may not work because there's simply no product market match. All right, so they just die off silently, not because they are out there to fool you. Now, let me just conclude. The key takeaway: information gap in crypto is large, and this information gap, so from the perspective of Launchpad, will be the information that is being disclosed, and sometimes you hardly see any disclosure. Now, more importantly, if you talk about how the protocol work, unless you have the technical knowledge to read the codes, otherwise you don't really know whether what they say is what is being implemented. You simply have to trust them, unless you know how to read the smart contract. So information gap is reasonably large, at least relative to traditional investments. Investment protection is very, very minimal. is something. It is a wild west. If you choose to invest in crypto, not only do you have to live with the volatility, but you have to live with the possibility that you will lose everything and you have no fallback. Okay. Finally, what are the traits of good crypto projects? So as I mentioned throughout the presentation, technology is one. Again, when you invest in crypto, just like you invest in everything, you need to develop a point of view. 5 years down the road, how is it going to look? All right, and based on that point of view, you decide what to invest and how much to invest. The recommendation now is to have, around 5% of your assets parked in alongside with your traditional asset. So, what do you look technology? Would this technology going to solve some really hard to crack problem? Is it going to improve the existing situation? Is it going to do better than centralized finance? So again, this is your point of view. And you develop your point of view based on what you have seen elsewhere, cross-sectionally and over time. And what powers, what basically sustains the technological development? It will be reliable and talented team. You need the team to make things possible. And you will know whether the team is good or not. For example, by looking at their programmers and by looking at their contribution in the GitHub space. Is this guy respected? Do people tend to, copy or rather learn from this guy? What is the reputation for this programmer? So these are things that you look at, signals, little weak signals that give you a sense of how you should look at things. And next will be strong community support and alignment. When you talk about ecosystem, the community matters, not just the founding team, not just the coders, but also the miners and the investors. Everyone within the system matters. And finally, you need to have strong token economics. If you talk about blockchain, right? The whole system is designed based on how you incentivize people to be part of the project, right? For example, because you do not have hardware on your own, you are going to rely on others to buy the hardware to get things run. Now, if you want people to do that because they are paying the electricity bill and whatnot and the hardware cost, how do you incentivize them? And there are many ways to incentivize them, but more importantly, you have to gain their trust. And to gain their trust, it is not the reputation of the founding team. It's basically the process. All right. For example, the proof of work and the proof of stake. So token economics is also very important if you are designing a DeFi app, because you want to get people to be involved in the ecosystem, for example, in governance matter. So it is a very important area to look into. And here you need people who are hardcore coders, really good ones. You also need economists to basically design the right incentive to get everyone to do with a common goal and everyone to do what they should do. All right? Okay. Now, that's pretty much what I have. Let's open up the discussion.
All right, thanks, Prof, for the insightful sharing. So we've received quite a couple of questions in the Q&A session. So perhaps we can start with Brian's questions. So Brian is asking if there are any recommendations and views on crypto mining. So shall I comment on that, Prof?
So you're talking about crypto mining?
Yeah.
Okay.
Probably general in.
Okay.
Yeah.
Lai Yuen, I remember you are involved in some crypto mining projects, don't you?
Yeah. So, there are different types of mining that I'm doing. So there's the hardware mining, where it's like what you said previously. So we use hardware to mine certain cryptocurrencies, and there's the more software component where we typically call it liquidity mining. So we stake some assets and get more coins in return. Yeah.
Yeah, if you talk about mining, the key thing is to ask the question, what is the future of that token to begin with? You want to be mining a token that has a future. And if you talk about the different way to mine, there are so many different way to mine. What we are familiar with would be those that leverage on CPU and GPU. But there are also miners that basically leverage on the memory and your hard disk, SSD. So, but all this doesn't matter. What matters is really, is there a future for that token? Because when you mine it, you get that token, right? And what you hope is that the value of the token would go up over time. If you were to sink to zero, it doesn't matter. So it goes back to that token. It goes back to the business model, the use case, the community that support the particular ecosystem. All right? And then you ask the question, all right, how do you mine those coins? Is it cheaper to mine with with SSD, with your memory, or with your GPU? So then you talk about how to optimize the costs, but it has to start off with a token that is promising, at least has a good chance, at least from your point of view, good chance to survive in the long term.
Yeah, definitely. And I think you can view it as mining as a way to gain greater exposure on a token that you have conviction in, as you said. So let's say you strongly believe in the future of Ethereum, instead of just buying spot Ether and holding it on a cold wallet somewhere, you can instead mine Ether, and the amount of capital that you sink in to set up your mining equipment vs just buying Ether and holding it might give you a greater yield in the long term. So
Yeah.
it's yeah.
Yeah, that's a good point. It leads to the point of this particular niche, and this niche is cryptos that earn you interest. Staking is one where you can lock your, for example, Ethereum and earn more Ethereum. The other would be the like of liquidity pool. So for liquidity pool, you stake a pair of tokens, and then you get incentive out of that. And this goes back to your incentive design. How do you optimize in such a way that everybody get to benefit? Remember, the founder themselves depend on everyone else because it's decentralized, right? So he has to find a way to share the benefit with everyone in the form of token, and all sorts of incentivization scheme.
Yeah, I think that's a great point. All right. So I think moving on to the next question. First, we can start with a question from Luke. So Luke was asking about what source would we recommend investors to validate the legitimacy of a cryptocurrency project and avoid the risk of getting scammed from more malicious players in the system.
So you are an investor, right? And you invest in some early crypto ventures. How do you do that, Ian?
So it depends. Usually, I do a lot of research on Twitter. So Twitter is surprisingly a very key part of the whole crypto industry. You have a lot of analysts and people there sharing research on what crypto is, which is really the whole decentralized movement, right? Instead of a Wall Street analyst, it's a crypto analyst, probably a guy in a basement somewhere, right? So I source my information online. I read social media outlets. I read the white paper. I join the Telegram chat, look at their Discord, and try to assess how genuine is the community. Um, what is the project trying to solve? Is it a real problem that can be solved, like you mentioned? So that's generally how I avoid getting scammed. Yeah.
Okay, let me just share with you my research. It was on ICO, but I think it would still apply for IDO. So what we did is to track their technological progress, which is basically their GitHub activity. On top of that, we also look at the founders and founding teams background. How do we look for that? Some of them will tell you their LinkedIn profile. Of course, the question now is whether that face is real. That's another question. But what we systematically find is that those who are out there to scam, they tend to do nothing after they get all the fund raised. What do I mean by that? So when we talk about ICO, you list and then you get people to invest, right? Now, once the money come in, then you either do work or you run away with the money. And what we see is a systematic, trend in which those who are out there to scam, they basically did nothing. And sometimes they try to basically cheat the public with some really well-known, people in the crypto world. Okay, just to raise their profile. So as a result, the fundraising, when you include those really influential people, and by influential people, I'm talking about, guys who are involved in many other ICOs. All right. So once you include those people, what we find is that the funds they raise higher. The probability of successfully raising money, meaning going beyond the soft cap, is higher. But the moment the ICO is off, when the cryptos are in their pocket, development tends to be worse than others. So that's one thing that we see. And the other thing, when we talk about relatedly, valuation of crypto, in our research, we define valuation the following way. This is not not everyone agree with this method, but the way we define is the following. We take the market value, okay, over the on-chain transaction, right? So you have an outcome, and we try to explain this outcome is the light of your PE ratio, where the E here is the on-chain transactions, and we try to explain what determines this, and we find a few factors that determine the MVT. One would be the user base, positive relationship. The more the user base as it grows, the stronger the MVT. The other is really the technological progress. So I'm talking about the progress from GitHub. How many changes has been committed and so on. So from there, you basically have a sense of how you determine the future of a crypto project, right? Number one, whether the community is strong, and community here would include the user base, right, as well as the programmers. And number two, whether technologically they are making progress. Right? If they are not making progress, that's a bad sign, right? That means they're not working. So this is my point of view.
Yeah.
So in short, there is no single source for you to evaluate the light of launchpad crypto projects early stage. You basically have to pull information from different sources, and sometimes if you want to be lazy, one way is to rely on the digital exchange. Choose those that are trustworthy. Not that they will definitely shift out the bad ones, but at least they will do the job for you, and this will reduce the odds of getting burned. Yep.
Yeah, definitely. Yeah, I think those are great points, Prof. Yeah, I think if anyone follows through the whole process they outlined and actually conduct their proper due diligence, the actual risk return ratio in cryptocurrencies can be a lot greater than traditional assets, because you just buy the things that are not scams and you might easily outperform the whole market, right? Yeah.
But of course, it's very tricky to identify scams. You can't even be sure the LinkedIn profile, the face that you look at, is the person behind. Unless the digital exchange do some kind of identity verification behind the scene.
Yeah. Yeah, definitely.
All right.
Right. Yeah. Right. So I think we can move on to the next question. And
right.
This So question comes from Jonathan Tan. So Jonathan is asking about the Ethereum London hard fork and pending transition to ETH 2.0. So I think this question driving at would this help Ethereum stay ahead of competitors like Solana and Cardano? And what are your thoughts on the potential of ETH overtaking Bitcoin in terms of market cap dominance? Yeah.
When you talk about market cap dominance, it's a bit like predicting whether Intel is going to be bigger than AMD, in the future. It's very difficult to predict. So again, to answer this question, it really depends on what is your point of view, 5 years down the road. And to develop that point of view as to who is going to overtake market dominance, you got to ask yourself what is the product roadmap that they have disclosed. For example, you mentioned about London hard fork. This is part of their product development plan. It has been postponed, but basically they give you a sense of what is to come. And from there, you can evaluate whether the technology is going to be superior. Is it going to enable more use cases? Is it going to solve the scalability problem? Some pain points that are already been flagged out by the community. If the team of developers or the founding team listens to the community, that's a good sign. All right. The worst case scenario is to invest in an ecosystem in which the problems that have been highlighted are totally ignored. Okay. So the question now is, what is your point of view? 5 years, right, of the business model, the use cases, the superiority in terms of technology, and it's hard to say who is going to take the lead in terms of technological edge, because all of them are going to evolve. And the mere fact that they evolve is a good sign, because as they're willing to spend time and effort to make the ecosystem better. That's a really good sign. And maybe that's a reason why some ecosystems slowly die off and some ecosystem continue to stay dominant. EOS, for example, is slowly dying off. Well, at least relative to Ethereum. And if you were to look at what is their product, map and what are they doing over time, you can sort of predict how things are going to look like in 5 years.
Yeah, definitely. I agree with you, Prof. And I think another thing to consider is actually network effects. So this is something that we also talk about a lot in our disruptive theory classes, right? So what Ethereum has is that it has a long history of developers developing new financial experiments on it. So you have the likes of Aave, Compound, and all of these new tech stacks that are trying to challenge what they term as TradFi, right? The problem with newer protocols is that they might not have the same amount of mind share among the top developers for whatever that you can think of. So in the long term, comparing different networks of different usability, I think it'd be reasonable to expect that network effects will accrue in more developed networks. So it's hard for Ethereum to be overtaken by a new network unless that network is like 10 times better. Yeah.
So let me build on what Lai Yuen has mentioned. So if you talk about Ethereum is a bit like Ali many years ago, right? And then you have a few other newcomers like WeChat, right? Now, here's the thing. Yes, if you talk about ecosystem, you have network effect, and network effect in many forms. So we are talking about indirect network effect. As you bring one person in, that person may find other application useful. So the growth is going to be like your telephone network. If you have 2 phones, you can only make 1 connection. But when you have 5, when you have 10, the number of possible connections is going to go up, not linearly, but exponentially. So that's the idea of indirect network effect. And on top of that, you have what we call the bridging network effect. So basically, you build new use cases, and then you get the existing customers to embrace the new use case or application, right? However, there is one thing that would sort of negate the effect of winner take all. That would be what we call multi-homing, because a new ecosystem, for example, like Cardano or Solana, they can do exactly the same thing with the same indirect network effect, with the same bridging network effect. And the switching cost is actually not low. I mean, not high. The barrier to entry is not high. So there's room for multiple players to exist, just like the case of Ali and Tongxin. All right, so I do foresee the case where Ethereum or a single ecosystem would dominate the entire space. But the presence of a few players because of this multi-homing economics.
Yeah, definitely. All right, so I think we have time for one last question. And after this question, we would address the other questions on the respective social media platforms. So how does that sound, Prof?
Okay.
All right. Yeah. So the last question that we take would be from Ryan. So Ryan is asking, what impact do you think the impending regulations will have on crypto? So, and he's coming from a concern that even if you do our research on the best coin, we think that this coin is going to be a 10x. But if regulations turn against your investment thesis, then you will still lose your investment across a broad range of crypto assets. Yeah.
Absolutely. The systematic risk is really, really scary. Now, let me tell you fundamentally what is the problem with crypto, right? When you have crypto, you can't use crypto to buy Pizza Hut. You can't use crypto to buy Char Kway Teow, right? So the use case is very limited, even after 10 years of development. In other words, your purchasing power is still defined by your fiat. That means whatever crypto you have, you still need to convert it into fiat in order for you to spend, turn it into things that you can eat and use. And this is one of the key vulnerability. So let's talk about what we have discussed, USDT, etc. There's one example. Tether is basically one of the gateway. So it interacts with other exchanges. And then if you were to clamp down on that, this is going to create a ripple effect across the entire crypto world. And let me share with you the worst case scenario. The worst case scenario is where all the countries around the world issue a UN resolution that says ban crypto. Now, if this were to happen, what will happen is that all your cryptos are going to be stuck in a neverland. It can't be converted into fiat. Why do we see this problem? The problem is that DeFi and the crypto was still built upon the centralized finance through those gateways. Without those gateways, you can't turn your cryptos into fiat. And if regulation were to go hard on those gateway, then things are going to be really, really bad. So it doesn't matter how good is your point of view with regard to a particular token. If all the gateways are cut off, crypto has no value. Now, the question is how likely is that? Personally, I think the case where a UN resolution from different countries is going to be very, very low. In fact, if you were to look at the language from the central bankers in the United States, they are actually not that against crypto. In fact, they seem to have the opinion that let crypto have a chance to develop because who knows, they might integrate with the centralized finance in a way that would vastly improve the existing financial architecture. That's the view they are taking. That the two would merge together to make the world better. It's a bit like back then when you look at fintech, like an incumbent bank, right? When you look at those fintech doing so well, you think that the incumbent bank are going to die. But have they died? More than 10 years have passed. The incumbent banks, many of them are becoming stronger. How? Because they partner with fintech. They coexist. So, the line of DeFi and crypto, I believe that, in the future, they are likely to basically work with each other and make the financial gambling architecture around the world much better than what we see right now.
Yeah, I definitely agree with those points, Prof. Yeah, and it's also exactly like what you said at the very first part of your presentation. We should only invest what we're willing to lose in crypto and be comfortable with seeing significant drawdowns. So regulatory systemic risks are definitely one of the key catalysts for such large drawdowns in the near future at least.
Yeah. So remember, if you want to touch crypto, ask yourself, can you stomach losing every single cent invested in crypto, right? Number two, can you bear with the daily price fluctuation of 5% and the 40% potential drawdown in a single day, right? If your answer is yes, then you might want to consider having some exposure when you put it alongside with traditional asset. It may add some spice to the risk return profile of your investment.
Yeah. All right. So thank you for your time, Prof. Lee, for sharing with us your insights on cryptocurrencies. And thank you to everyone for taking the time on a Wednesday evening to attend our session. And if you're interested to find out more about cryptocurrencies in general, do stay tuned for the next 2 episodes in this series. And the next episode, happening 2 weeks later, will focus specifically on getting a career in the crypto industry. So if you are someone who's convicted on crypto in the long run and interested in starting a career in this brave, new, exciting field, do tune in next week. Right. And with that, we've come to the end of our session. Hope that you found the whole session insightful.
Thank you very much. Thanks for your time.
Right. Thank you.